put your money, invest your money in a money market fund, and you are guaranteed protection and growth of your money because money market funds are very secure. They are tight secure. These are the reasons. Number one, it's segregation of functions in the money market funds between autonomous enterprises or institutions. That is, we have the custodian, we have the fund manager, we have the trustee, and we have the regulator, who is CMA. Fast forward, the fund manager and the investment firm. The fund manager has two clear duties in this investment. That the fund manager is charged with the responsibility of seamlessly investing the funds and distributing returns from the investment, together with accounting for withholding taxes. Number two, we have the custodian. This is an established bank. This bank or this person, his role in the investment is the safekeeping or protecting the funds or the money for investment. And therefore, the responsibility of the custodian is to keep the funds. And number two, ensure that the fund manager adheres to the fund tear sheet or fact sheet, which establishes where the money should be invested, so that the fund manager does not assume unplanned or unanticipated risks. Then we have number three under function, and this is the trustee. The trustee is usually another bank, an established bank. And the trustee duty in these functions is to ensure that the interests of the investors is taken into consideration and protected. What are the interests of the investor? One, an assurance that the money that he has invested, the capital, is protected, should not be lost. Number two, an interest that the investment's returns shall be more than the current inflation rates in order to cushion his money from loss of value or from loss of purchase power. And number three, growth of the investment by the fund manager investing in opportunities that guarantee or give returns that are higher than the inflation rates, among other interests of accessibility, flexibility, and others. Then we have the CMA, the laws and regulation. The CMA, the Capital Markets Authority, is the one that is charged with implementing regulations and laws that govern the market. And therefore, the regulator oversees the entire functions of all other players in that market. He is charged with the ultimate responsibility. And therefore, in the event the fund manager or the investment firm was to face difficulties and perhaps collapse, then the function of the Capital Market Authority is to ensure a seamless continuity of investments in that fund by appointing a new or another fund manager to continue with the investments. We have, at that point, have to look at then, what is the highest or what's the worst that could happen to cause a loss As we have identified in these functions, the money sits with one bank and there is another bank that is charged with the responsibility of a trustee. Then it means it would require a total collapse of the entire banking system in order for money market funds to collapse and perhaps lose the investments. Therefore, at that point, we are safe, we are secure. But further to that, number 2 is the regulations, diversification of the investment portfolios. Under regulations, through the watch of the Capital Markets Authority and the trustee and the custodian, the fund manager is not allowed to put more than 25% or a quarter of the fund into one investment. That is in order to minimize the risk exposures to that fund. In that, in the event the worst was to happen, only one part of the fund would be affected, and that is a maximum of 25%. Therefore, in such a case, that diversification of the investment portfolio, and these ones are the ones that are outlined in the tear sheet or the fact sheet, that is under the watch of the custodian, to ensure that the fund manager adheres to that tear sheet and does not expose the fund to extra or unanticipated risks. That is also under the regulation that the fund manager will not invest in less than 4 investments, thereby putting more than a quarter of one investment in one investment. Number 3 is geographical presence or markets. Most investment firms have geographical presence in different places or different countries, and that exposes them to different markets where they can invest the fund, and that also gives us a geographical spread of risks, in that when one region is doing poorly, the fund manager has other options or choices to invest in other regions. That may not be applicable to all the money market funds, and therefore it's a self-responsibility of you as an investor to choose and look at that as a factor when you are choosing your preferred money market fund. The other level of protection is the high returns. Money market funds usually guarantee returns that are way above the prevailing inflation rates, and that money market funds are invested, or the fund is invested in high quality short-term or near cash investments. Then it means as they are adjusted, the rates are adjusted as the inflation changes. For that reason, that gives a protection to the purchasing power of the money that we put in those investments, and also gives us or guarantees us growth of our investments. That said, money market funds sit well in established sectors, where we have money market funds that sit with the established insurance sector. We have money market funds that sit pretty well with the established banking sector, and we have other money market funds that sit well with the established investment banking sector. And for that reason, and as established, money market funds are operated by educated, exposed, and experienced fund managers. And for that reason, for security, these persons, the fund managers, have acquired huge skills out of the 3, education, exposure, and experience, that allow them or enable them to mitigate risks and perform market adaptations where needed. Money market funds are secure, tight for our investments. Thank you.